Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts, and I'm joined by our regular team of Paul Strome, Nicole Dines and Dan Innes. Paul, let's start with you. What's your pick of the week?
Well, I've been looking at the office sector, starting to see a lot more research looking beyond the pandemic, and two interesting reports recently. Firstly, from smart building software platform Metrikus. They say that their data reveals that UK offices saw more workers present in the third week of April than at any other point since the start of the pandemic. During the second and third weeks of April, the number of employees working in their offices was similar to September 2020, they said. And on Wednesday, 21st of April, there was a peak of 44.72 of pre-pandemic levels of occupation, marking a new high in Metrikus's occupancy index. And also, in a Knight Frank report, it's been revealed that 1 in 4 firms will relocate their corporate headquarters after the pandemic in order to improve office amenities or adjust workplace strategies within the next 3 years. This is the latest edition of the firm's Your Space report. It's UK focused, so it'll be interesting to see how it applies throughout Europe. The firm forecasts significant activity in the office market during the next few years, with competition for the highest quality and best located space. The firm surveyed 400 international businesses with a total of 10 million staff between them. 90% said that real estate is a strategic device for their business. About 49% said corporate brand and image is the top strategic priority fulfilled by real estate. And 37% thought offices are a tool for improving employee well-being, collaboration, and for attracting and retaining talent. Crucially, while the future of the office is in question, Knight Frank also said that 30% of firms plan to increase their total office space within the next 3 years. Tech firms will be the biggest drivers of demand for office space, and about 39% of those firms planning to expand and identified as TMT. The firm's global head of occupier services and commercial agency, William Beardmore Gray, said that the firm's wanting to give employees the best of both worlds, allowing them to work flexibly, but making their offices the best possible experience.
Yeah, interesting that discussion around the tech companies looking for extra space. There was a lot of the big tech companies announcing significantly higher profits, as well as Amazon, whose revenue rose from $75 billion to 108.5 billion for the 3 months to the end of March, tripling the profits there. Nicole, what have you been watching?
Well, on the e-commerce front, there's a UN report that's coming out this week, which shows that it's not surprisingly, e-commerce has gone up last year, and it's gone up to $26 trillion on a global level, from 16% of total sales to 19%. But interestingly, South Korea is the first country with over 26% of sales done online. China is second with 25%, and the UK is third with 23.3%, so by far the most e-commerce friendly country in Europe. And on the retail front, we had a real asset media briefing, and all actors seem to agree that now that the economy is opening up again, traditional retail will come back, driven by the support the governments have given. That's given consumers confidence, and obviously all the pent-up demand, but also the massive savings that people have made during the long months of lockdown. While we know that food retail was very much the winner during the pandemic for obvious reasons, and non-food retail is set to see the biggest increase. And looking to places that opened up before Europe, like China, we've seen a big, strong comeback of traditional retail, and even luxury retail that even moved into sort of secondary cities. And the same thing seems to be happening in the US, where, as we know, like in the UK, the vaccination program is going well. So there's a lot of optimism about retail, obviously changing, innovating, but definitely coming back in a big way because of all that pent-up demand from people and desire to spend. Real Asset Media also had a briefing on residential, and growth is set to continue. All experts said that residential is now on every investor's radar screen, and it's also because it's seen as a safe haven, but it also gives a lot of possibilities because you can invest in affordable housing. You can invest in high-end, there are all sorts of student housing, there are all sorts of possibilities. But interestingly, it's very much connected now with sustainability and affordability. So it's very much driven by the ESG factors that we've talked about. There's been 46% increase in transactions this year, while transactions in general have gone down 28%. So it still seemed to be outperforming in 2021, even more than it outperformed last year. And on the affordability and sustainability front, there's a really interesting development that Catella talked about. Catella is investing. There's this engineering company called Elithis in France that has come up with this energy positive towers. They're residential towers for affordable housing that generate more power than they consume. So obviously the energy bills are much lower. They even get money back by selling the power they produce. Catella is investing in 100 of them across Europe, starting in France, going on to Germany and the Netherlands and UK. So that's just one example of how resi is not standing still, but it's continuing to innovate, and especially on the sustainability front.
I was interested to see a recent report from Alessandro Bronda at Recor, focusing on London markets, but it highlighted the pace of vaccinations across the world, and there's a clear gap between the US, UK and continental Europe. And this seems to also be reflected in recent forecasts for GDP growth, with Goldman Sachs predicting high growth in both the US and UK, but also Barclays Boss Jes Staley predicting the biggest economic boom since 1948 in the UK. Dan, what have you been following?
I've been speaking to my colleagues in Paris, and they're delighted about an unlocking of retail and society in France that was announced last week. They've had an extension to their curfew to 9 p.m, and there's going to be a reopening of retail on May the 19th. So it's great to see countries following their roadmaps around Europe. Meanwhile, it's been a raft of activity for URW. That's Unibail Rodamco Westfield. There's good news that's been sort of perfectly timed to offset its latest set of results, which unfortunately confirmed a 40.8% year-on-year drop in revenue for the first 3 months of 2021, amounting to 566 million euros. That's really not a surprise. Chief Exec Jean-Marie Triton said, the group centres were effectively closed for an average of 42 days in the first quarter, with the exception of essential retail. The company's also become the latest real estate company to link its finance to sustainability. And they've agreed with a syndicate of about 19 banks to refinance more than 2.4 billion euros of debt due to expire over the next 3 years, but with a new 5-year revolving credit facility linked directly to its sustainability targets. But the positive news that they've also released around this time of their results is they've lodged fresh plans for a £1.3 billion residential development at White City, next door to Westfield London, with buildings up to 45 stories high, which is going to include about 1,760 homes. And that's up from 1,100 homes in the plans, which you'll remember that Westfield had approved in 2017. And that's just before that epic $25 billion deal in February 2018, when they sold out to Unibail to create URW. And meanwhile, as well, we've also been following Unibail Rodamco Westfield's selling off some of its interest in Austria and Slovakia for around 930 million euros. So watch that space as it kind of rebalances its books. Back in London, Hines has secured consent for a mixed-use retail and office scheme in London's West End. That's on the corner of Oxford Street and Bond Street, with a building that's around 37,500 square feet over 8 floors. But the scheme's going to provide a total office area of about 31,000 square feet when it's completed, including a large communal roof terrace. And basically, that planning consent allows Hines to retain a significant retail presence at ground floor and at first floor, which of course is so important in the West End. The surprise news in terms of office space and residential space in London, the City of London Corporation has announced last week that it's planning to convert empty office space into resi in a bid to revive the area. And this is, of course, the historic Square Mile area of London, which typically is business only. But they want to create at least 1,500 new homes by 2030. And that's going to also include about 35% of affordable housing. So a real shift there and one to follow. And lastly, the world's largest Italian food market, Eataly, has finally opened to the public in East London. And they intend to open more indoor restaurants and a cookery school on the 20th of May. But that's a 42,000 square foot Eataly, and it's in Broadgate, which is a stone's throw away from Liverpool Street Station, which of course in around there is London's largest pedestrianised neighbourhood. So that's it for me, Richard. I'm just going to go off and give Boris Johnson a call on his mobile phone.
Great. Well, we've all got his number, Dan, so that's very clear. Thanks very much, Dan. Thank you, Nicole. Thank you, Paul. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the news in the real asset markets. Thank you.